Everybody, Michael Martin, happy Monday. Hope you're doing well. So, a little housekeeping. This week is going to be the last week of videos and podcasts, so to speak, for the rest of the year. I'm going to take some time off. I'll be back in early January. So, I'll have episodes all week. Friday will be the last one for December. And then I'm going to take some time off, get some other things done. Today's episode, however, we're going to talk about four things that this is four things that I've identified that I see successful traders do, pro traders do, that really add up to their success, and I think that you should follow them. So the first one is they use protective stops 100% of the time, no limit orders, buy stops and sell stops. They put those orders in and they honor them. They don't come back in and renegotiate the price when the thing starts to leak against them and before the stop is hit, meaning like if you're long, you don't put a protective stop in and then drop it lower because you're afraid the whole thing's going to get hit. And that's the point. You put your protective stop in because if the trade does come against you, you want it to get hit. You love your protective stops. They save your life. That's how you have to look at them. I don't like using limits because they are usually there for you when you try to express like you have a price target or something. And don't take it the hard way, but you're not smart enough to know how far the move can go, right? Because that starts to deal with prediction. And my thesis is humans are horrible at prediction. Second thing is they position size based on some type of volatility metric. They're not coming in and trading 5 gold, 5 S&Ps, 5 crude oils, and everything like that. They're going to base their position sizing based on the prevailing volatility. You can use standard deviation. You can use average true range. But whatever day or amount of time that you pick for that moving average, be consistent and use it across every instrument. What happens is if you try to trade and say, well, I want to do the E-mini and risk 10 points, you might find that the volatility is actually 25 points for the time frame that you're trying to trade. Even if you're intraday, the lowest ATR value that I would use would be the daily, like 14-day, 20-day, something like that. I wouldn't say, well, I'm trading 15-minute bars, so I'm going to use the 15-minute ATR. I think that's a mistake. So position size, use your protective stops always, put them in, don't renegotiate, honor them. Position size based on volatility. Third thing is if you can't see on the weekly chart that something is beginning a trend, then to me there's no sense in going long, for example. If we're in a sideways market, and this might sound kind of obtuse or crazy for many of you out there, but like as long as NVIDIA, for example, is in a $100 trading range, it might make sense to stay out of it, right? Because what you see there is a market full of indecision, even though the range is big. Some of you might look at me and say you're crazy, but the majority of people who try to trade inside of range-bound markets are going to lose. That shows you that neither the buyer nor the seller are in control. And in my opinion, especially if you haven't had success in trading, you'd want to try to buy when other people are buying. So that kind of skews the wind at your back, so to speak, because at least you know the thing is going up. The shorts have to cover. There's lots of buying pressure above the market. So don't try to, sell short, rallies to try to get cute and fade moves. I think that's a losing game. And don't try to, buy rallies in downtrends or don't sell short uptrends. Trade with the trend. Look for, weekly or monthlies, developments, and then downtime to the day. Whatever you do, don't start looking intraday because you want to try to find something based on very, very random data. If it's not showing up in the weeklies, then there's no trend. Move on and find another name. Many of you have to give up the idea of trying to focus on one instrument. Over the past year, I've gotten lots of emails and comments from people who are struggling. And even though there is volatility, which probably is what attracts the people to the marketplace, focusing on one instrument means you're kind of blinded to what's happening, which could actually be easier or better trades for you in other instruments. Again, if your account is underfunded, I don't know what to tell you, right? There's nothing I could do about that. And the fourth thing is don't look at your P&L during the day. I know that probably seems like, well, how the hell am I know if I'm making any money? Well, the best you can do is put your buy stop in to get long. You get filled, you put in your protective stop. You can't make decisions on the fly about your exits at that point because you don't have any skill. you don't have any feel. And so trying to interpret what's happening in 1 minute bars is a fool's errand as far as I'm concerned. Again, based on the stuff that I got and the comments and the feedback and the emails sent directly to me over the course of the past year, I'm going to try to work on some themes that, coming into this week and tie some things up, and then also, give you some things to work on going into, January and Q1. So those are the 4 things. Use protective stops and honor them. Sometimes it's emotional and you can't find yourself doing it, but until you can do that, I think you're going to have random results that are all over the place. Position size based on volatility. Every instrument out there has a different temperament and a different personality, and you need to know that, so that if you do it that way and you're trading a sizable account, you might find that you can trade only 1 crude oil. You might have 3 gold contracts. You might only be able to afford 27 shares of a particular stock. Like it's not gonna look uniform in the terms of the number of the shares of the contract, but from a risk profile, they will all be equal across the board, and that's what you want. You want to adjust the volatility and not go chasing vol, because if you don't have any skill or any feel, chances are you're going to just give your money away. And that's always a good thing to do if you have the extra cash, is to make donations, but at least direct it to some charitable organization that you want. I would say also to put on your trades with the direction of the prevailing trend. It can help you for ways that you don't even understand. You don't know when all the buying pressure is going to show up, but you want to have that wind at your back. Trying to go against the grain means you're trying to solve some type of emotional thing inside your body, that you're smarter than everybody. And until you have a better feel, trying to go against the trend, to me, is the worst thing that you can do. Once you get a feel and you know that you can make money, then sure, look for reversals and do this and that. But I would not start there. And then also, don't stare at your P&L during the day. If you're putting on, trades, and the first thing that you do when you're filled is go look at your P&L, trading might not be a good fit for you, because that's an emotional concern. From what I've said over the course of the year, that you're going to lose money probably half the time or more. And that's something that you should reconcile before you even start putting on any trades, right? This way, you're emotionally balanced. The last thing that you want to do is watch the ticker start losing money. That's going to invoke or induce you to do certain things that you have no business doing, that probably are going to work against you while you're in the trade. So the best thing to do is figure out where your entry is before you even put the trade on. Also, calculate where your exit's going to be. All the math is done ahead of time. There's nothing to do unless you want to be entertained by watching things, or you have strong feelings that you need to reconcile. You can do that in any number of men's groups or what have you. But watching the screen all day isn't something that pro traders do all the time. You have to check in once in a while, set some alerts, adjust your protective stops. That's it. But trying to think that you can make decisions on the fly with no training it's not laughable. It's probably what your instincts tell you to do, but you don't have your instincts in line with the market at this point. So the best thing to do is just put your stop in and then walk away. There's nothing you could do to steer. There's nothing that you can infer really by looking at short-term data. That's all I have to say about it. Again, these are comments that I'm making based upon the feedback that I've gotten. There are people, of course, who are great short-term traders. They have great feel. I know some of them. The point being is that the majority of people don't have the feel, and they're not going to get it either. And then they're relegated to just failing and not trying things on longer time frames, where the odds of success can increase for you. So do what you think is best for yourself. I don't know. But these 4 things that I'm recommending today are based, again, thematically on what I've seen coming to me from questions and comments on the channel over the past year through 2023. And if your trading is struggling, or if you're struggling with your trading is a better way to say it, you might consider using any or all of these coming into Q1. You should be thinking about, your plans and your goals for 2024, not 21, for Q1 in 2024. And make it about your behavior. Don't put out things like, I want to make X amount of money. We'll get into that later this week, perhaps. But anyway, those are the things that I thought were very, very prevalent and issues that had come up for viewers. I appreciate you all being here, and I'll see you tomorrow.